P500 hits all-time highs. Semiconductors are breaking out of a major base, and the driver is not what you think it is. Uranium's test of its 15-year base and how it held. Smart money, dumb money, what it's actually telling us. We've made this pattern a couple times in the past 25 years, and it's pretty significant. Why IBM and AMD's news on Friday is a game changer and how it's going to follow through into next week. IBM's 2 days of consecutive buying rivals anything that we've seen in the past decade. What's driving this move and why it can still continue. We're going to look at several breadth indicators that I think are really significant. To just start, I think we go here and look at the McClellan summation, and we can see that we're already starting to point up and head back to that zero line. This is in stark contrast to what we've been doing since September 8th, which has been dropping. So this takes a long time to turn around, and it's finally doing that. What we're going to do is we're going to drill into the S&P and the NASDAQ and tear them apart and see what's going on there. Super important. Volatility is telling us that we don't really have a lot to worry about, but under the hood, the volatility of the volatility is telling us a different story. 27.5% of you do not subscribe to this channel. Remember that these videos come out at different time. They're smaller clips that come out during the week. And as well, we also do a lot of things with the community tab, and you only see the community tab apparently if you are subscribed. We have a lot to get into. Let's jump right into it. Everybody, welcome back. Well, to start with the basics, we obviously have this control bar from Friday, October 10th, and we call these control bars because they really are in control of the action until they are breached. And that's exactly what happened on Friday. Surprisingly, even with the CPI and the lack of data and what's going on with the government and in the instability out there right now, which we do have to spend some time on, there you are buying equities. And they're buying equities most likely because of the rate movement that they're expecting to start coming because of the CPI, which we will spend some time on. But I think that this is really important to get from our first way to look at what we're about to go into. What is exactly happening? In other words, let's not talk about what we think is going to happen, but let's talk about what actually happened, and then we can figure out how to profit from it. So all they did was have this bar come down October 10th, and then from there, what happened? They played around, hit a couple of these fib levels, bonked us around a lot. 50 is not a fib level, but I use it as a demarcation line. Super important to look at this. And when you see this, you can see exactly what I'm trying to show you. You can see that once that bar broke, that 50 line, which again is not a fib, but it's a great demarcation line, we never really were able to stay below that 50. We never really closed under it. And so that kind of gives you a bias while you're waiting to figure out how this is going to play out. And for me, it made it pretty clear that you have a long bias to the market as long as you're not breaking that 50% line, but you have to understand that you probably don't want to be there holding the bag. We were fortunate enough that we actually got out before this big drop started coming because there were a lot of signs that it was happening or that it was setting up, and getting out of that way and allowing this to reset sometimes is the best thing that you can do. Now, you're not always going to catch tops doing that, but you do see a rebalancing when you get a move like that. And if anyone thinks that this was not this huge move, well, in one day, if you look at the futures market, it's about a 4% move on the S&P. It's a really big move. And if you use the rule of three, that means that you could have 4%, you could have sectors that actually were down 3 times that, and you'll have stocks that were down 3 times what the sectors were down. So real clear way to look at what 4% means on the market. Now, to put it into perspective, does it mean a lot? How many 4% moves do you really have here in a day? You don't have a lot. Besides all the winning and liberation that we went through back here, you really don't have a day where you're having those kinds of moves. And I think that's very important to understand that, and don't placate it as if, oh, I should just hold and go through that and white knuckle it, because if Friday looks like this, you have no idea what you're stepping into on Monday. You'll have people that'll say, based upon my knowledge, blah, 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 whatever, man. You have no idea what you're stepping into on Monday. You don't know what kind of tweet you're going to get over the weekend. You just don't know what you're dealing with. So you have the gap up on Monday, and everybody thinks it's fine, but you have to look at how this played out. And this is really important, again, for people to understand what we were dealing with. This is what you dealt with on Friday if you were still long. Rallies up, comes back down, retests that 23.6, rallies back up, hits that 78.6, bonk, comes all the way back down. Does this look like something that you're going to be able to hold stock into? Not really, no. You could say, oh, I can. Okay, maybe you can white knuckle this a little bit, but again, that's not a process. That's just a test of wills, which is not really the best way and not really something that you can repeat over and over again, right? You might be fortunate and it might work for you, but if you're swing trading and you're going through this, This is a nightmare because you're tripping stops left and right, and then they're reversing. So in these kinds of environments, you have to use different strategies. Oversold, overbought, different strategies. There's different ways to do that. We could actually do videos on when you should kind of flip from, oh, I'm going to use the moving averages to, I'm in a trending market to I'm in a free fall and we're trying to figure out which way we're going to go. And there was some real stuff here. We had the whole talk of double secret tariffs again. We had the whole talk of Russia escalation. There's a lot of issues out there, but they did seem to get blown off. And again, these videos, when I do them raw. I don't edit them. They are what they are. So just bear with me as we get through it. But core inflation, consensus versus actual across the board, all came in light. The problem with this data, and when I was doing the public pre-market, why I wasn't crazy about this data was, all right, great, but you're not giving me any basis for this data. In other words, you calculated CPI, but where's the PPI? What did the producers pay in order to get here? See, because if you take the PPI and the CPI and you look at those together, the core is what we're paying, right? CPI is what we pay when we buy that burrito. PPI is what it costs to make the burrito. The difference between those two numbers, think of it as corporate profits. So if PPI is up and CPI is down, corporate profits are weak. You want to know that. So we have one data point going into a Fed meeting where we know that they're going to cut. The question is how much? And you're getting some signs of that from the market. But I do think that there's some things here that are super important just to capture very quickly. So go to a 4-hour, look at the RSI, see what's going on here. All right, so the RSI was oversold here. And then from there, we can start seeing how it's trying to get back up. But it never really gave us a true divergence in here on the 4-hour. You low here and then you undercut here. You could make the argument that this drop was not commensurate with this drop. We did mention, that on the 17th, we did get this bar that was pretty powerful, and we'll just show it. You have your cut here, and then here you are on Tuesday. Then you have your cut here, and then you can see your drop. Why is this so important, and why do you care? Because this, at the time, was an H. So if we just kind of came to this, it wants me to change this symbol. I'm not really sure why you want me to do that. Let's go back into this and go to this. Come on, Boomer, get it together. All right, good. So if we kind of come to here for a second and look at it, you'll see that you have that H. So you have the failed H pattern in there. And I think that that's super important. Right. So you can see, okay, well, you came into the failed H. And when you see that, you could say, yes, this might be something to get involved. And this is an area where we started adding the things, picking at them, I think is a better way of saying it. But then we also had those credit problems that you'll remember where Zion Bank was going to be an issue. Right. They were coming out and saying, well, we have these loans and they may have lied, which is a nice way of them saying that we probably didn't do the due diligence we were supposed to. WAL, same thing, complete implosion. And that was coming off the banks of Jeffrey. Right. So we were looking at Jeffries, and Jeffries was like, by the way, we own these bonds and they're an absolute dumpster fire floating down the river with a bunch of raccoons. Probably not the best move we ever made. And the stock dropped on credit concerns from about 70 down to about 46, where it looks to have bottomed. And of course, we also have like these other moves like Ares that are in private credit and AL that are in private credit. And of course, that they're having a little bit of issue right now as people are looking for that canary in the coal mine. Could it be one? Yeah, based upon what happened with Tricolor, it's a real issue. Based upon what KMX said about the car market and some of the loans out there, that's why they imploded. And that's how the whole thing started. And then Tricolor picked up. Yeah, it's an issue. We have to see what's going on with the private credit market. The larger issue with the private credit market is it's called private credit. So if there's an issue with private credit, then it's their issue. It's not really going to stem and become systemic unless it affects the regional banks. When it starts doing that, well, then it becomes a problem. But based upon what Zion said and WAL said, it doesn't really look like it's a problem. It looks like it's a one-off. So I think that that's really important for us to understand. So then when we flip back into this, we can kind of see that battle that's been going on with those names and why we started lifting again after all that, all the noise. All right, so then we have exactly what's been happening. You can see Wednesday's drop down, the retest, and then we start lifting again. I would have really liked to have undercut here, but I can't get everything that I want, right? So I have to take what I'm given. So if I look at this, I'm okay with the movement that we've seen. I'm not crazy about the movement that we've seen, but I am getting the breath, and the breath is getting better. So we can say anything we want about it, but this is what we have. So we did flip, and just for time's sake, if I take a look at the NQ, you'll see that you're not over as much for one. And if we look at the NQ up here, I appear to have this volume profile on from earlier. So what we're going to do here, the volume profile, is just take that off and remove it so that we can just talk about the fibs. So And this was your CPI movement, which is kind of interesting, isn't it, that it did that? And we do have some drivers out there now. We're getting real quantum versus fake quantum. And I think that's very important. That's definitely something we're going to have to get into today, at least touch on it so that you guys can start doing your due diligence, so you can start understanding how AMD and IBM, why they're moving the way they are. I do want to touch on that a little bit. But I think it's more important to get a sense of what's really going on here. So we drop it back to the 4 and we have, the sky is falling, everything's bad, double secret tariffs, everything out there, Russia escalations, yada, yada, yada. Then we're going to have private credit issues. And then the market's like, hold my beer. We're going to hold that 23.6 level right in here on the fib. And now we're going to bounce higher. And then we kept rejecting here, right? We kept rejecting over and over and over again, more rejections than I got from Giselle. So it's definitely an area of interest. Finally, we flip through and we push. Let's clean it all off and then dive into it. This is what you have now. So we can say anything we want about the market, but there's the top and we broke through it. And you broke through it on that CPI. Now, to me, that CPI was not great, but it just wasn't because I don't have enough data behind it. But nobody cares what I think. And you have to realize that you can have your opinion, but you have to trade what happens. So if they want to push them higher and they're going to get us through, then that's exactly what's going to happen. And I think that's really important to get. If we look at our levels, we're not really breaking those levels down. What I would say here about this that I thought was super interesting is you say you're starting to fan a little bit where the trajectories changing a little bit. I use the bodies. You should use what you're comfortable with. When you start fanning like this, it can start leading to a larger push. And smart money, dumb money is really telling us that. So we can either listen to that or not listen to it, but it's definitely there. And I think that that's super, super important. It's minor, but it's there. Now, if we look at the breadth for a sec, in front of you is the NDX. And then above, we have the NDX. And what we're looking for here is stocks above their 50-day moving average. And we can see really clearly what's happening. So if we mark that level off and just drop it, you can see that we're breaking out. And what I like about this is up, the retest, and then we're going again. We're above 50, and we've been talking about this for some time. So the breadth of the NASDAQ 100 is actually getting stronger. I would actually argue that the market is getting stronger by the names that are rallying. Some people get angry when I say versus the garbage that's been lifting, but a lot of this stuff is garbage. And it is what it is. So we're going to go through some of that and some of this rotation that we're seeing out there. I think that's super important as well, because you are having rotation from some of these junk names into these real names. And that's where institutions are going to come in. And then that all ties into smart money, dumb money, and why they're not going to want to get out as fast as they were trying to get out before. It's a thing, and we should discuss it, and we should tie it all together. So if we look at 63.36, that's a pretty good number. So if we look at what happened the last time that we broke below 50 to 63.36, we always want to look at a chart and say, is there another time here where we did something like that? And we can just kind of go in here. I can click on my trusty circle and we can just kind of go, all right, up, over, down. Okay, so that happened right here. How did that go? Oh, well, that went pretty well. All right, so maybe that's something that we should pay attention to. Where's my little circle? There it is. And so then we would look at that kind of section in here, and then we go, oh, look, we gapped up when that happened. Isn't that interesting? Isn't that special? And then we would kind of look at it again and say, what did we do here? Well, we gapped up again. Okay. So what you're seeing is you're seeing the same exact pattern behavior. Remember, guys, I'm a pattern trader more than anything else. I'm looking at patterns and saying, if then, right? I'm not the brightest bulb. So when they go out there and they show me what they're doing from what they've done in the past performance is the greatest thing that we have. We don't really have anything else that's anywhere close to past performance. It doesn't mean it's going to shine through. It doesn't mean it's always going to work. You popped over here, you rejected, you popped over again, and you cleared it, and you did go higher, and then you just completely fell out of bed because we had all that winning and liberation, right? So you could still have the macro events out there, and this is probably a great time for me to draw a stool so people get this. You have the macro events, and then other than that, you also have the fundamental events. And then, of course, you have the technical events. So you have your three major events, right? We can always talk about the reaction of the market to those events, which would be sentiment. People would say that you should have four legs on your stool. This is my stool. You do what you want, whatever makes you comfortable. So macro is going to be what the heck is going on? Double secret tariffs to China. Good earnings are coming out. Bad earnings are coming out. That would be fundamentals, right? But what's going on macro? What's going on with Russia, Ukraine? How does India feel about us telling them what they should be doing with their oil, right? That kind of stuff. Anything that's a macro event. What's going on with CPI and PPI? How long is the government shutdown going to be? How is that going to affect people's spending habits, et cetera, et cetera? This is what we really want to pay attention to. right in here. So that is what the heck is going on. And then, of course, you have to deal with the who's affected, what stocks are affected by what's going on, who. And then you're going to deal with the technical. When do we trade that? So you always have what, who, when, or macro, fundamental, technical. And then as you're always sitting on a stool, sometimes you're leaning on the back leg, and that's going to be more important. And then sometimes you're leaning on the front leg, and that's going to be more important. But you always want to look at the who. Right? Who's affected by it? And then from there, that tells us what names we should be trading. But the technicals really tell us when we should be getting involved in that. And that's why doing this kind of work is super important. So when we look at something like this, we're going, oh, well, that makes sense. We did that here and we broke out. We did the test, the retest, and then we went. So we did the test, the retest, and then we went. Very similar behavior. Now, not to be left out, we're going to deal with the S&P and the S&P in the 50-day. And we can see exactly how this is going, where we are lifting up, coming back down, unable to get through that 50, tries, fails again, and then we have that lift. I think this one's a little more interesting, and what we'll do is we're just going to mark off that 50 line as close as we possibly can to there, and let's see how close we can really get with it. There we go, boom. And then looking at this area, and then you can see the battle of that 50, and then you can see when we break on that 50 and why that's not so great, right? So when you finally break on that 50, you're like, ugh. And then you kind of see you try to fight through it. It doesn't work. Guy holds a piece of cardboard up. Things don't go too well for us. But look what happens when we flip it and retest that area. We actually start getting signs, and then we start lifting and start going higher. And you can see again on that 50, we broke down and held that 50. So up, over, and then we're going. So we really want to watch this. These are at, to me, the S&P is at more of a critical level than the NASDAQ is. So I'll say that again. I think the S&P is at more of a critical level than the NASDAQ is, because the NASDAQ, the large cap names, it's very clear what's going on there on the order flow side. And that's going to leave us to this chart, which you guys have seen before, but I think it's important to show it again. Now, what I'm seeing and what you're seeing is the S&P 500 50-day percentages divided by the NDX 50-day percentages. And I showed this chart a while ago and said you can always tell when we're getting close to that bottom or going to have some kind of bottom in a market, because you'll have these rises where the S&P on a percentage basis, 50 days will be doing better. And then when you start to break down, you'll start to see it in here. Look what happens. This is super important to get. Why? Because you're starting to see that change in trend. The NDX is starting to outperform. And you can see it here in April, how it happened. You could see it here in September 1st, how it happened. These are big events. And if you just go back and mark any time, August 5th, this is obviously when Japan yen trade. You can see how we spiked up into this and then we started to roll over again. I think it's super important to get this because to me, it does tell you something. It does say, hey, they're favoring the NASDAQ over the S&P. Now, what we do want to do is just be cognizant that do we hit a level on this where enough's enough? And it could lead us to some kind of like, oh, hey, we overshot on that level. And that can happen. You know, you overshot here early October, you overshot here December 18th. So if you start getting down to that 0.5 level where you overshoot, it's so egregious, yeah, that does become the other side of this trade. But for now, this is doing everything that it's supposed to be doing. Now, I'm getting sent this one chart repeatedly, and I just want to talk about it for a second, how I view it versus how other people might view it. So in front of you is VVIX. And I don't have the watermark on because I don't want it to block this. But really what the VVIX is it measures the volatility of the VIX. So the VIX measures the volatility, the VIX measures the volatility of the S&P, usually used for a 30-day range on whether or not they're buying puts. Think of VVIX as the velocity in which they're buying puts. Are they scared? Are they not scared? And then when they panic or peak, that gives you an indication. So if you take a look here, like Friday on the 17th, you had max fear on the 17th, not on the 10th when the market fell down, but on the 17th, you had max. Now, if we go back and look at that, people would say, oh, well, that definitely gave us a sign. It did. One thing I would just say about this is that there are levels to it, and I think it's important to understand those levels. So if you're below 80, everything, all is well, nothing to see here, right? So that's kind of that below 80, all is well, nothing to see here, everything's good. When you start getting into anything between 80 to 100, like that's pretty normal behavior for this thing to be in here. It's when it starts getting into 110, 120, when you start seeing anything over 130, that starts to really become the level. But what you're measuring with this VVIX is you're measuring the volatility of the market. So if you're at 100 or you're in here, you still have panic in the market, meaning they are still panicking and buying options. And why this is important to get is because a lot of people will look at the VIX, myself included, and I'll be like, that doesn't really make a lot of sense. Like 16, everything's going on. We have 2 wars out there. I'll clean all this off. 16, we have 2 wars going on out there. We've got, tariffs on, tariff off. We've got a lot of instability. What's really going on out there? And so then when we look at this, we just go, okay, what do we do about this? Well, no one seems to be afraid. Well, that's not really true. It's not really true because then when we look here at the VVIX, we see they are afraid. And it's that fear that we really want to pay attention to. So when people are saying, oh, well, this is, these are these extreme moves and we have to pay attention to it, then what people will do is they'll take the fear, the vol, which is the fear of the fear, is what they call it, and then they take it by the VIX. So they divide these two by each other. And then they say, oh, well, when this starts to fall down, that means that they can't buy them fast enough, and that's what we need to get in. And a lot of people are talking about that that's what's happening in here. I don't view that that's what's happening in here. I view you have some uncertainty that's happening in here, and that you had a position in here where that may have happened on Friday the 17th, and then you have bottomed. I would actually argue the exact opposite, quite frankly, because I'm seeing a lot of beware of the tsunami that's coming. A lot of people are sending me these articles. I guess they're finding them on Twitter. And what I'm going to do here for our purposes is I'm going to take these candlesticks and turn them into a line to get rid of the anomalies. And then what I want to do is I'm just going to drop a line from here over and then see if there's anything there that I could use. So we're taking the VVIX, dividing it by the VIX, and then we're looking at that and saying, oh, well, we took the fear of the fear, and then we're seeing how fast they are actually out there buying some of these, these items. And I know some of this stuff is, a little esoteric to people, but this is institutional level. Like this is the stuff that institutions look at. And you always want to follow what they're doing because you really want to get yourself in a position here where you're understanding how big swaths of capital is actually moving through the market so you can ride the wave. Remember, they're the sharks, we're the remora. We don't move the market, they do. So we're always trying to figure out what they're doing so we can go figure out where our next meal is, if you think of it that way. And if we look at this area, we'd go, okay, well, this was April 18th, 2024. Anyone would remember this area. This was an area of great interest, right? And then anyone would look at this and go, August 5th, well, that's when we bottomed in that area. Well, what happened there? That was Japan yen. And then, of course, this is when we started with the peak in the market. And then the market obviously did its thing. And then we could see the drop that happened in the market, and then you can see where we are here. So do we have a similar pattern? I would argue that we don't. And what I would actually say is that what I'm seeing is an emphatic kind of bottom with the movement, where if we took the candle in and of itself and marked off these candles, these inflection point candles, you had one, and you had one right here. And I think that that's really important because those kinds of candles have been marking these bottoms, whether this was the April 24th bottom. And I'll show you that chart in a second in case people don't remember back in the day. But I do think it's important to look at this stuff. And when people show this stuff and do what I refer to as critical thinking, which seems to be something a lot of people don't want to do anymore. But I think if you look at this stuff, you can kind of get a sense of it and go, all right, well, here's that April 18th where he keeps yammering on about what happened. Well, we bottomed. Okay, well, there's that August 5th. He keeps yammering on about, well, what happened? Well, we bottomed. Okay, well, we're getting a similar pattern right here on the 17th. So we can either look at that or not look at that, right? And I think that's super important to get. Let's get to smart money, dumb money. Now, in front of us is smart money, dumb money. And if you've been here for some time, you know that we don't refer to it like that. We refer to smart money as institutional, and we refer to dumb money as retail. And you'll see why in a second we refer to it this way. But what's most important is to understand that smart money is really something that is thought of as an institutional for this reason, the way that they calculate it. So in other words, when they look at smart money, they're using huge lots to determine what smart money is. They're using futures. They're using CFTC data. They're using a lot of different data here that you wouldn't really use or expect dumb money or quote retail to use. The two most important things about this is that smart money or institutionals, we're going to now refer to it, and dumb money, which we're now going to refer to as retail. The most important thing about this is that smart money moves slow, dumb money moves fast. And if we just remember that, this will start making a little more sense. Smart money is more rational. Dumb money is a little more irrational, but can move faster because it's retail. Remember, smart money is calculated solely based upon large order flow, whether that is in the option market, the futures market, CFTCs, it doesn't matter. But that's an important distinction here that we need to address as we go forward. What I would say, looking at the 5-year, you could see real clear what's going on here. And there's some history that I think is worth paying attention to. But if we look at what dumb money or retail's doing, we haven't gone anywhere. And I would consider the majority of people watching this are not trading, huge swaths of capital, meaning tens of millions or hundreds of millions of dollars. So if we're looking at this level right here, look at that mark where we got over. In other words, where's that cross that happened, right? In that area. All right, so we crossed where smart money or institutions selling and retail, dumb money is getting in and staying in. Now, this is one of the reasons why we don't refer to it as smart or dumb, because that's going to constitute that what they're doing is wrong. That's very clearly not the case here. Anybody would rather have been in the market from this period of time on and just stayed in the market. Why retail or institutions rather are getting out, we can see the difference there. So why do you care about that? Why is that important? I think it's important for a couple of reasons. One, we always want to challenge conventional wisdom when we look at data. And I'll explain what I mean by this. Just because the data is supposed to tell you that if dumb money is not buying and smart money is buying, we need to be out of the market, that's not really the case. What we're looking for is change in trend, meaning if smart money starts buying super aggressively, which they're now doing, and dumb money or retail is not getting out of the way, that tells you that you're going to have more demand in the market versus smart money can't wait to get in and dumb money's puking. Institutions are rushing into the market and retail is puking. This tells you a great example and why someone would look at me and say, well, that's very clear. That's why you should call it smart money, dumb money. Okay, that's fine. But now that fits that narrative. What about this narrative? What about the narrative here where we have smart money or institutions puking and retail rushing in and they're guess who's picking the bottom here? And I think that's super important. Who picked the bottom here? Well, clearly retail picked the bottom. So it's more an understanding and a nuance, and you'll understand in a second why I'm getting so into this and why this is so important. And we haven't gone over this in a while, so I do read your comments, and I've been asked to go over this for some time, but I really haven't had a reason to. And now we have what I think is a major inflection point, and I think it's worth paying attention to. And if we look here, if we take it down to a 3-year, we can see that inflection point just a little closer right in here where smart money ran up and now it's starting to roll over a little bit, and retail versus institutions, retail's getting back in and they're starting to tick up a little bit. What I find so fascinating, and you can see here when we look at the year, it's almost as if we have a shelf right here or support on where smart money is trying to get through and it can't. And retail, dumb money, is sitting here. And it's like when we get down to this level, we get buyers. It's kind of interesting. But nonetheless, what I find most fascinating is we had a sharp buying smart money. And if I'm to look at this on this basis, here, this is on the year, this is 5 years. Let me go to the year and you can see it much clearer now. And we could see our level right here. Every time that smart money starts getting out and retail starts getting in, you'll get these inflection points. And I think the inflection points are super interesting because what starts to happen is stuff like this, where you'll see, like right here, for example, and then we just mark that up, you'll see the market just start grinding. And this is May. This is after all that winning and liberation that we went through. And you can see the difference here, where in March, again, this is why we don't call it smart or dumb, who went to get out in February and March? Pretty much everybody, right? Institutions are piling in and retail's like, no, thank you. We've had enough winning and liberation. So I think it's really important to understand the dichotomy of this and why people are looking at it. And I think I've hammered that home enough now. Look how fast we moved here. And this to me is very important, and I'll explain why. So if we look at this chart, and this is Sentiment Trader, this is not something I created. I have no affiliation with them. I've talked to them in the past, and they're fine with letting me use this and show it. So here we are, early October, and it's like, yep, they don't want anything to do with the market. And then all of a sudden, in a very short period of time, they can't get in fast enough. A matter of fact, I think it's safe to say if we look at institutions over the past 12 months, there was no period of time that we have in this market where they had to get in that fast. Even when we fell apart, they didn't try to plow into the market as much as they're trying to plow in and as fast as they're trying to plow in right now. Now, with everything being shooken out there, or shaken, I think it's shaken, not shooken. Everything out there, well, you're not watching this because of my English and grammar, that's for sure. So if you're watching this right in here, we're holding and we're starting to lift again. What I want to see is I actually want to see smart money or institutions getting out of the way, because they get out of the way slow, as we talked about, and then retail gets involved and starts buying. So if I'm up here at like a 0.6, which means that smart money or institutions' coffers are filled and retail starts buying again, well, we start lifting. So I'll explain this. So if you're here at 0.6 and you come over to 0.6, and we'll just draw this line here so you can see it. I'm going to give you some examples. All right, so here's 0.6 in that area. And then all of a sudden we have institutions saying, I'm out of here. And then all of a sudden retail saying, I want in. All right, so that's an inflection point roughly around the same time where we have that buying right in there, and then we have institutions selling. Well, we have that inflection point in May. We're starting to get that here. Now, we're going to have to monitor this for the next 12 weeks or whatever is left for the rest of the year. But I find that very interesting, and it fits perfectly with some of these other indicators that we're going to go over in what's going on there, because you are seeing a change. And these changes are so important because you have dynamic and you have static. And when people that try to stay static and say, whoa, 2 weeks ago, you said blah, blah, blah. I didn't have the data that you have right now 2 weeks ago. And that's the important thing about the market. You have to constantly analyze what you have now, and you have to let go of opinions. If you thought it was going to crash and it doesn't, you have to go back and reevaluate. If you thought it's going to go up and it falls on its face, you have to reevaluate. You constantly have to look at the data and process what's going on and let go of ego. I see it so many times where people are like, no, we're definitely going to crash. I'm right. No one's ever right or wrong. You just either make money or you don't. And what we're trying to do here is we're trying to establish just what's going on with order flow. What are institutions actually doing? And based upon the way that they are calculating smart money and institutions, one thing is irrefutable in looking at this. Institutions are buying stocks and equities faster than any time based upon this calculation than they have in the past 12 months. And I do think it's worth noting, how many times have we seen an area where institutions and retail get close to one another, reject without crossing? So we went back through about 25 years of data, which is really the majority of data that they have at Sediment Trader. Again, I have no affiliation with them, but they are fine with me showing this. And this is roughly around that 0.5 area. And what you're going to see is you have all the crosses, but you have some areas where you don't have crosses. So if we just kind of drop those areas, you'll see that they're sharp, pardon the voice. And then after the sharp drop, what happens? You rebound. So you have a sharp drop like we just had, and then you have a rebound. And this happened on 16 and then again towards the end of 16. And I think it's super important to just grasp that. Now, if we keep going through this, we'll have another example here in 1 second. Here we are from Jan 11 to Jan 14. And there's a couple examples here. There were not a ton of examples, but in this one, if we look again, you're roughly around that 0.4, 0.5 area, really. And so what we're going to see when we're here, this one that took place, well, you bottomed again, and then you never really could make it through a higher high, and then we collapsed. All right, 2013, and we have an uptrend. So what we're looking for is characteristics. In other words, is the sample that we're looking at have more or less similar characteristics to what we're dealing with? Are we currently in an uptrend? Yes. Are we currently trading sideways? No. So if we're not currently trading sideways, which one should we weight more? Well, we probably should weight this one more. We should still understand that this one's out there. We should definitely understand this one's out there. And nevertheless, it's still called a bottom. And nevertheless, it still took out a new high, which is really what we just did in the market on Friday. But the majority of these, what I'm finding with these particular trades where they don't cross, is that you already are in an uptrend and it's just providing liquidity for people that want to get into the trade. The majority of these in 2018, 2019 did cross, especially here. You can see it here as well. The one where we really crossed very, very briefly and they kind of were aligned was right here. And that looks like you're pretty much right before the pandemic, which obviously we have to take out just because of the movement associated with it. And there's nothing really there. I mean, there's kind of this one, but even if we look at that one and we see like how that played out, you can see the dip again, but they weren't anywhere near as close as what we're looking for. So if I took a look here again, here we are right around the end of 2019 or third quarter 2019, and we're lifting again. Super important to get this because what it's doing is it's providing liquidity. And as long as we don't find ourselves in a position where retail wants to puke, which they don't really want to do, then this is actually becoming an opportunity where people are putting money to work and doing quite well. And that's going to take us into 24, where if we look right around, because it's about June or July 23, and we mark this one off, you can see that you have an uptrend and that this presents an opportunity. What I'm noticing about the ones that make the most sense is when you have your retail and you're up in this area and it's staying there, and then the smart money gets as close as humanly possible. So for me, what I would take from this is, yes, it's definitely an inflection point, but I would argue that this one is actually stronger because you have institutions getting in as fast as they can, and retail really hasn't done anything yet. So retail really has not gotten involved at the same pace that institutions have. And now that they're full, we know, and we're up near that 0.6 versus the 0.5 where all these others were kind of taking place down here. So that means that they have more, and that means that they have more supply, and therefore that any demand is just going to create a bigger move. So as they start getting out of their positions, which is usually very slow, and retail starts getting into their positions, this can lead to what we refer to as just demand, and there's very little supply or less supply, and then you're going to get those kinds of moves out of it. And I do think it's really interesting to look at this over the year and realize that since you've had that liberation and winning, from that period on, you really haven't broken a key level, and that's drawn pretty poorly actually. But if you look at that level, like 0.6, you're not really breaking it on the dumb money side. So what does that mean? It means if retail starts breaking 0.6, maybe we pay attention to it. Maybe we start getting across like this. But for now, we're not. And I would argue that this is pretty bullish for equities. So what exactly happened on Thursday and Friday to IBM? And this is the most significant piece of news that I think that I can give you right now to get you prepped for the week. Out of everything that's going on in the tech sector right now, when I look at this, it's pretty significant. And I really still don't think a lot of people got it. Obviously, the stock extremely well after earnings, way better than anyone would have expected. You came down, and I think that this is so telling. There's the 55. We just came right down to it, hit it. I actually came in short this, covered it into this. We actually wound up going long with the thing that thought we were going to gap fill. And then obviously the news hit. We're going to address that news in a second. But I think it's really important to understand the shift that you're saying in real quantum versus what I'm going to refer to as fake quantum. And not to annoy people, but if it does, it does. And then why is AMD doing what it's doing? So the very first thing we have to do before we get into the technicals, as we do when we look at the stool, is understand what's really the driving force from this. And there's an article that really explains this very well on what's going on. If you find this video interesting, I'll make sure that obviously that you subscribe to it, but getting this out there and sharing it is super helpful. And I really appreciate when you guys show me that you're doing that. And the reason for that is I put time into this because I'm trying to show people what it actually takes to be successful at this, to actually get an edge in trading. So when you share that, you'd be surprised, the emails that I get on that, and I do appreciate it. So let's get to it. So what happened? Why AMD and IBM shares just took a quantum leap? Get it? To record highs. Get it? See, I worked that into the title. Brilliant, right? Shares of AMD, IBM jumped Friday. Readily available and reasonably priced AM chips can run key quantum computing. So what's so fascinating about this is everybody's saying we need this, we need that. IBM's like, yeah, we're using these AMD chips and they can do what we need them to do. By the way, we're going to build this quantum computer named Starling by 29. And the head of research told Reuters that it works and they're a year ahead of schedule. So if they're a year ahead of schedule now, the question becomes, where are they going to be? Now, this is where it gets super interesting. Shares of the two companies jumped to record highs. IBM could run a key quantum computing error correction algorithm. Now, one of the key problems with quantum computing, and I'm going to be real clear about this, I'm not an expert. We actually have people that are in this field in the community, and I was talking to them about it, and it's absolutely fascinating. There's a key quantum computing error that happens, and that algorithm is easy to get and reasonably priced by AMD. So AMD's chip apparently fixes this error correcting algorithm. Okay, above my pay grade, but it sounds important, right? Reuters said that the research paper to be released by IBM on Monday. So Monday morning, IBM is going to release this paper that it can run those algorithms in real time on a kind of chip called a field programmable gate array semiconductor manufactured by AMD. I'm not saying that again, but you see what's happening here. You're seeing IBM saying, oh yeah, we know quantum computing's huge. We know you guys are in the field. We see all these other companies out there that are saying they're going to do this, they're going to do that. Yet we're ahead of schedule by a year and we're doing it on these chips. So we have this whole AI theme that's playing out. And then at the same time, you're going to start having this quantum theme that is now a year ahead of schedule. Now, what this does, if you really think about it, if you thought that AI and the AI spending was going to slow down, let's say that the AI spending slows down and all you do is roll right into quantum computing. And I don't think people are getting that part of it yet. They're definitely getting the IBM play to an extent, but I don't think they truly understand how IBM is so far ahead right now. And I don't think people really even got that on the conference call on Thursday. I mean, I certainly don't think they brought it up enough. AMD shares, which have more than doubled since the start of the year, were up nearly 7% mid-afternoon on Friday. Starts 7% year-to-date, 40%, second biggest gainer in Dow Jones. Shares of Micron, why? You're going to need more memory. Then you're also going to see not only do you need more memory, but where are you going to store all this information? I think when you start thinking about it from a storage and a memory standpoint, because if you are going to run these things and you're going to be able to figure out and calculate it faster and faster and faster, thousands of times faster than we can right now, where are you going to store all this data, right? So you're going to need memory and storage. And then you start running into the same exact problem that you had before. So not only do you have the AI competing for memory and storage, well, the quantum computing is going to wind up competing for it as well. I think that when you tie this together, it leads you to some pretty big conclusions. The first conclusion, and I'll clean all this off, the first conclusion, technically speaking, that's a very clean breakout on the chart. But one conclusion would be that they're going to be light years ahead of everybody else. And once AMD starts getting embedded in IBM on the quantum computing side, that's it. It's pretty much game over, right? Until something comes out that's better. Now, that makes it look at like NVIDIA and go, okay, well, how does NVIDIA fit into this? I'm sure there'll be something out there. But if you have something that is cheaper and in supply and you have access to it, they're going to use that. So I would expect AMD to really continue to lift on this. And just disclosure, I do have positions in these. The IBM move is just absolutely astounding on what it's done over that short period of time. But I think you have to tie this all together and go, well, there's a couple of things that you need. You need memory, you need storage, and you need power to do all this. So you take the AI side of the trade, where we're all looking at the IRENs of the world and saying, oh, maybe they bottomed, maybe they didn't, right? Maybe they did. You know, it's very clear that some of these names look really good. And you also have that competing now with, you remember the Blackstone article where they're going to have $40 billion worth of data centers, right? That whole thing with McGuire. You can look that article up. We went over it in a past video. So then we go, all right, well, they have these data centers. They're going to need more space for all this. They're going to have interconnectivity space. Well, who does connectivity? Well, AVGO does connectivity. Well, maybe that's why AVGO moved. And they came out with that new product called Thor Ultra. You guys can Google that. I do a ton of research, guys. So, I just don't get into it in these videos. But if you look into this, it's light years away from anything else that's out there. That's one of the reasons why people don't understand that, like ALAB, come on, work with me. That's one of the reasons why ALAB is just falling down like the pig that it is because that AVGO now is a competing product that's like significantly better than it. All right. So if you have this and you go, here's AMD and AMD's breaking out. Okay. Well, what else do you need? Well, you're going to need memory. Well, that's for sure. Okay, so there goes Micron above its call wall. Okay. What else do you need? You need more memory. There goes SanDisk way above everything. Okay, now this starts to make sense. And people would say, well, you don't need the memory for quantum computing, yada, yada, yada. People want to store everything, guys. So where do the storage names move now or they don't move? They're going to store everything. Now, maybe they're going to get out of the storage business because they're going to use the memory versus the storage. But if you're going to compute all this stuff, maybe you don't store it, but you sure as heck need the memory to remember it or so you don't do it again, right? So I think that's why memory is moving over storage. I could be wrong on that. You guys are welcome to comment on that as well. So you have this new driving force out there, and we have this new data point that's going to come out on Monday. And that's why these names were trading the way that they are. And they possibly might be something you might want to watch on Monday and see how these names go. But I do think it's significantly important to then go out there and say, well, if they are going to store it, you're starting to see these cloud names, something like NBIS, continue to lift. And that is something else that I think that you should be paying attention to. But you tie it all together and go, well, wait a minute. Don't we have a power problem? Right, you do have a power problem. The easiest way to look at the power problem that no one's actually looking at is that utility companies have just been absolutely rocking this year, and people don't even understand why, because they generate the power. We're all so busy looking at uranium. But this actually feeds into the uranium group because you're still going to need the computing power. I mean, it's not going to run on hamsters, so you're still going to need even more power than we thought. So here's where it gets interesting. If you have AI pulling for power and you have quantum pulling for power, you don't need less power. You need more power. Well, where are these power sources going to come from? And it's very clear that we're leaning towards something like uranium. All right, so then you have quantum computing and chips. And then chips need what? Well, they need rare earth, right? All right, so they need these rare earth. So maybe start looking again, and we might have to start looking at these rare earth because we still have that bottom going on with China. They haven't really jumped into the fray yet. But what I would say that this is the most damaging for is what I refer to as like fake quantum. These things that are trading up on like hopes and dreams and hop 'em, right? That have like $1 million a quarter. And then you have these battles going on where like, no, the US is going to invest in us. And then the US issues 3 statements saying, no, we're not. And then someone comes out and says, yes, we are. But if we really look at like how RGTI has been moving, a lot of this stuff, and this will get into the technical side of it, they're all moving based upon like these 2X ETFs. They're the things that are whipping you around. And if we really look at this, since this thing peaked at like 500, it's done nothing but rally and just offer opportunity to short every single day. I mean, it's not rocket science that if you shorted the open of this every single day last week and then closed it at the end of the day, you made money every single day. And now you have a shooting star. So it's not really rocket science what's going on here with these names. If you look at IONQ, you're going to go and compete. These guys are all going to compete with IBM, right? I mean, that has real money, real pockets, and real contacts. So I actually think that this has been out there for some time, and that's why you've been seeing these names completely implode. See, people have access to information on an institutional side way before we do. And I think that that's one of the things that a lot of people are missing. But like these INQ, QBTS, like all this stuff, I'm not saying that you're not going to have like rumors and things are going to trade up. Of course they will. But these things just basically just got a death knell with IBM saying, oh, hey, we're a year ahead of schedule. Where are you guys? How's your day going? Right? So they're having a bad day. And I don't think that that's going to change. What I think is going to change is we're going to start seeing different stories pop up. And I think one of the stories that we're going to see in 26 coming up is quantum and how fast that's going to start happening. And if that starts happening faster, then that's something we definitely want to feed into. But it's very clear that the name that's going to lead these two more than anything else is going to be IBM. And then IBM is relying very heavily right now on AMD. And their admittance of that on Friday, you really can't disregard. Oh, if you're trying to get into the community, make sure that you look this week and possibly even this weekend for an invite. And the link is in description. And I also pin it if you're trying to get on the wait list.